Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Friday, March 8th, 2019. This video, if you remember the site, this is pretty much a wrap up or a summary of the market analysis part of the video I covered earlier today before noon. That one had trade idea coverage on trade ideas, I should say, and but this one I wanted to just drive home the same points I made earlier and put this out on the on the site as public content as general market analysis. So so what happened today, this week, both today and the start of the week, ironically, Monday and today, Friday, I've seen the two most, by far, bar none, the two most significant technical developments I've seen now in months. I can say months. And what that is, first go back to Monday, these bearish engulfing candles. Remember, I stated this before, we had these on every index, all the index tracking ETFs except QQQ, and of all those, I'm referring to the Dow, DIA, Dow Diamonds, SPY, QQQ, MDY, the mid caps. I don't cover them often, but they're right there between the small and the large caps, and they're very significant. MDY is the ETF that covers the mid cap index, and then IWM. They all had bearish engulfing candles except QQQ, and of all the indexes, so to speak, QQQ is the only one that's not really a diversified index. SPY's 500 stocks, IWM's 2,000. And even though the Dow's only 30, I've talked about this a lot, it is representative. It's diversified among the economy. You have financials, you have industrials, everything in there. 11 different sectors to be exact. Or I'm sorry, 11 sectors in SPY, but you also have diversification in the Dow. QQQ is 60% tech stocks, and of those, most of the returns come from the top 10 components. It's very heavy weighted. So again, I just wanted to put that out there that for all intents and purposes, the market itself had those bearish engulfings on Monday, and as I said, as fairly reliable as they are, although nothing's 100% in trading. What you wanted to see, or what I wanted to see, and what I did see, is follow through to the downside. That's 4 red candles. You couldn't ask for any more confirmation from that. Does it guarantee that the market can't do this right now? No, there are no guarantees in trading. Does it increase the probability that we're going lower? I think very much so. Kickback rallies aside, and that's the thing I told mentioned today. Things we're getting a little stretched here right now, and so we'll see what happens next week. Okay, so the bearish engulfing candles, number one, and what happened today that really kind of seals the deal, and that would be bearish engulfings on the weekly. Now the weekly charts, this development today, I didn't talk about these earlier. I wanted to see what happened, how we closed the week, but I did cover today. I said no matter what, we'd have to rally 4% off the lows today to undo and not get these bearish engulfings. So I told everyone on the site, look, it's going to happen. They're going to probably make a run at your shorts today. I use that analogy on the movie Taken, when the girl's under the bed, Liam Neeson's daughter, and she's on the phone, and he says, "Listen to me. They're going to take you. They're going to." The same thing with if you're focused on the intraday charts right now, and you're trying to trade, volatility has expanded recently. Whether you're long or short, they're going to drive you crazy. They're going to run at levels. They're going to pop above, just above support resistance levels. If you are a swing trader or a longer term trend trader right now, I think this is where most of your focus should be, this and the daily charts. Ideally at this point in time, and I'll say it straight out, the bearish case, although it doesn't mean it's completely eliminated, but it will be severely dampened or hindered if we took out this week's highs, Monday's highs. That's a big bearish engulfing candle. As I said last week, or earlier this week on Monday with the dailies, this is a potential sell signal. I gave you the strategy for shorting above the highs. You can do the same thing now on a weekly basis. Only thing is you're going to have more room. Now you're 5 days down, or 4 additional days of selling. So Monday was really your most objective shorting day by far. Days to exit longs too, if you've been long and wanted to get rid of some long exposure. But from here, what you want to see is additional downside. Next week, another red candle. And like I say, it's slang term, I know that, but I say the redder the better. So if next week we had a very big, something like this, here was our last bearish engulfing that came at the end of an uptrend, and there was a confirmation and then some. You can't ask for anything better than that. And of course that set the stage for the move all the way down here, or just confirmed our sell signal, let's say. So that's what we'll be looking for next week. And if you're bullish and trying to buy dips, you can almost use the same strategy in reverse. Get the 40-week coming in here. You can set a stop somewhat below, let's say, this week's lows. Obviously, the markets are closed now, so you have the chance to wait till Monday, see what happens. If the markets open up and you believe this was a good buying op, do the same thing. Go long, set your stops not too far below this week's lows, and you might get that. And I'll tell you one thing in trading, fewer things in trading or investing are more bullish than a failed bearish setup or breakdown. So whether it's a chart pattern or a candlestick reversal pattern or something like that, because what happens is you get them, it sucks in a lot of shorts. They go in short. And then if you undo the pattern and negate the benefit, in other words, move above that candle, all those shorts are squeezed out. They realize they were wrong. The longs pile in when they see the shorts getting squeezed out. That's not my preferred scenario. I don't think it'll happen, but I can tell you from a risk-reward perspective, if you are bullish and you thought the market was going to new highs here, and you still do, then this is where you can go long. It might be a little more downside. Again, your strategy, it's all risk reward. It's all has to be factored in. If you think the market's going to, a SPY is going to, let's say, 300 right here, and you're at 274, well, that's a 25% drop. Well, you can allow yourself a, 5, 8, maybe even a 10-point downside to 265 or so for your stop. That's subjective. Again, it depends where you think it's going. But as I said before, this is just like I gave you my bounce target zone before to the upside, my same pullback target zone. If we're going to go to new highs, if this market will see higher highs in 2018 and keep the bull going, the same target zone I was looking for on December 31st when I did my year outlook for 2018 was this box here. So, and I can tell you it's still very significant support down there. It goes back a ways. So this would be for my, let's just keep it clear. I'm not trying to mix, cover both sides here, but if the bullish scenario is, longer term speaking, my alternative scenario, there's only 3 really: bullish, bearish, and I'll get to those targets in a second, or we go nowhere. We trade sideways for many months and nobody wins. But so that would be my alternative scenario there, and for that to play out, and I will certainly be on watch for things that might develop in the charts, dailies, weeklies, intradays, between now and then. But like I said earlier, this is anything below that line right here. We enter that what I call the WTF zone, where bulls, dip buyers will start to realize, hey, something's wrong. A lot of money will be lost for those that chased the high end of the rally. A lot of money was lost this week. Again, you can see this candle we wiped out in SPY in the last 2.5 weeks of gains. But this is where I believe you'll see cascading sell-off. We won't limp all the way down to test the lows, I don't believe. I think if we get anywhere close to those December lows, we'll just waterfall through them. It's my guess, but we'll see. And then, of course, we might set up for a nice divergent low if that happens down the road. That's why I had this line drawn like that before. Okay, and just real quick, again, since we're going back out to the long-term charts here, there's the bull market trend line off the 2009 lows. There's our divergent high, and what appears to be at this point still just a kickback rally with more downside to come. In fact, the way this trend line's drawn, we haven't even come in for a back test of the trend line yet. That's a possibility too. If we somehow pop above this week's highs, come make a run at or near the previous highs, also back test that trend line. So again, there's always almost a nearly infinite number of possibilities, and we'll just have to assess it as it comes. And then where we're going, most likely, I would say right about here. 214 give or take, and that would be from where we just peaked earlier this week. It's about 25% downside on the S&P. And here's QQQ, which could see, before all said and done sometime. And if it happens, I think it'll happen this year. I think it'll be 2018, because as I say, stocks tend to fall a lot faster than they rise, and that gives us about a, as much as maybe a 35% downside in QQQ. All right, and then finally, since we're on long-term stuff again, let's go here. Let's find a clean board. This is the same bull market uptrend line off the 2000. Actually, you had the QQQ again, because it's not a diversified index. It's more of a, I jokingly refer to it as a tech fund with an Amazon kicker. You had the low back in late 2008, where everything else bottomed in March of 09, all the other indexes. So there's your uptrend line, pretty clean, and as well as that 20 period exponential moving average, just done a bang up job of defining the trends. You can see it, all the pullbacks all along. Don't worry about candlestick wicks and shadows. This was a mini crash in QQQ that we're looking at here. You don't even have that long candlestick tail on the end NASDAQ 100 on the actual index itself. It was just a technical glitch, a little meltdown, a mini crash in some individual stocks. So just a lot of reactions along that trend line and that 20-month. We're above the 20-month now, and this is what I said. There's a lot to some work to do to really firm up the case for a much larger drop. But you can see from a technical perspective, let's zoom in tight. Too tight, it's hard to look at the candles. All we have since this whole thing started last fall was simply a breakdown of the bull market uptrend line impulsively, a back test. We back tested for, what is that? And these are monthly candles, so 1, 2, we're in our third month of back testing. So it will be very interesting to see how this month closes. And there's still some longer term trend indicators on QQQ that haven't yet. We had a couple little whipsaw signals there. Some indexes have rolled over on their longest term trend indicators, some haven't. So like I've said over the last few weeks, still a little more work to be done. But again, that's the long term outlook. And then SPY, you can see a similar situation here. Wrong chart. There we go. There's our uptrend line right there, the way I have it drawn here. Breakdown back test, and we're still below that level. So let's now zoom at the 60-minute charts and look what happened today. We'll wrap it up here. SPY 60-minute, you can see that's that initial target area I had here, about 273.13. So we fell to that, we hit it, and we saw a late day rally. The markets weren't going down, they went down a little today. And again, they still closed red, but what this most likely was, a lot of short covering. Those that have been shorting for a while, probably booking quick profits while they had it. Either way, it doesn't matter. For all intents and purposes, we closed pretty much on support there. Okay, and on QQQ, we have an active trade on this, so this isn't the board with all of my targets, but I had on the recent or the active official trade right now a support level at 171, and that's the level we hit. We fell to yesterday. It stopped the slide cold. You can see two candles there. We gap below it today, and so at the end of the day, they came up once, ran at it once, pulled back, ran at it again, and it closed at 171.17. So statistically, that's 17 cents on $171 share prices means we closed on a back test of resistance. So PPO is curling up, and I also mentioned this too earlier today in the video or in the trading room, that again, it wasn't objective this morning to short going down because we're getting stretched. You don't want to keep adding as the market goes down. This is the most oversold we've been on the 60-minute chart since the meltdown into the lows on Christmas Eve. So point being that although the longer term charts became increasingly bearish today, near term, nothing goes straight down forever, especially after a strong top. You get the initial dip buyers, so next week will be critical. We start taking out some additional support levels. What you'll see is more and more of those that bought in recently. I'm trying to go out to a daily chart here, guys. Here it is. So that's what we'll be watching for. More and more that bought over the last few weeks. You can see at this point we've wiped out already the last few weeks of gains, and if we continue lower, you're going to wipe out this pool of buyers right here, everyone that bought that breakout there. And so that's how it works. You have these little levels, And technical analysis isn't just magic. It's not just a bunch of charts. It's telling a story. This is just a story of where buyers and sellers have interacted in the past. And you know, they were watching this. You had a bullish candle there. Remember, we had that consolidation of breakout. So that brought in a new wave of buyers because that was a bullish breakout. And so now we watch that. And if we get down to that level, let's see if you know, the market holds. If we break below it, then we're getting close to that WTF zone there. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.